everybody, Homestead Financial, Jayson Hardie. We're here with Nicole Davis with Reliance Financial Services. So we're here to discuss, unfortunately, a divorce, but we've gotten through the first two, preparation during and now after the divorce.
Correct.
So you're here to help guide us through the process, and I'm here to kind of give a couple mortgage specific pointers to what we do after a divorce.
Right.
So, okay. So now, they've come to you for advice, they've come back to you during the process, and now everyone's divorced, they're starting on with their own lives.
Correct.
Again, so now we have to try to figure out what we have to clean up, or what have you seen, what's happened.
Right.
So from a credit perspective, what have you seen before?
So as far as after divorce or during divorce, after divorce. So after divorce, what I've seen a lot of times is that in instances where throughout the divorce they're not able to execute for various reasons upon their agreements, ultimately taking all of their joint debt out of each other's names.
Okay.
What I've seen after divorce is a lot of the execution. So we agreed that such and such debt would be paid off with funds from this account. And it would happen within 30 days after date of divorce, okay? A lot of times what I see is that people want to go ahead and buy a house, or they found the perfect house, or they want to rent an apartment or something like that, but this debt is still on their credit report only because of a timing issue. So a lot of times we have to work through or talk about, when needed, talk through, okay, what does the timing of this look like for you? Are there any options for speeding this up? To get you
so in other words, somebody can't come in and just wave a divorce decree in front of somebody and then disregard what's on credit.
Correct.
Right.
It needs to be paid off. It needs to be placed into the appropriate person's name based on their agreements, and that takes time. So that's one of the most common things that I see is that, upon the date of divorce, they still have some things in their own names because they're distributing funds from certain assets or accounts to pay off certain debts or move the debts into their individual names.
Okay, got it. Now, assuming if they came to you at the preparation phase, they would have executed and this wouldn't actually necessarily happen, but that's not always the case, right?
Correct, right, that's not always possible.
So what we see, we'll usually, this is where we normally come in on a transaction, is somebody needs to refinance, get somebody off of the mortgage, and sometimes that works seamlessly because people have actually executed with in accordance to a plan that you would lay out.
Right.
A lot of times that doesn't happen. So usually the number that we're trying to be able to get some people back to is 640. 640 is, you can get them as low as 580, you can get a mortgage, but the rates are higher, the mortgage insurance is a little bit more intensive.
Which means that also the monthly payment is going to be higher, so does that fit into their budget?
Yes,
yeah,
exactly. So we want to try and get them there. And then we also want to try and help educate people to go, look, this one still says it's a joint account. Well, the judge says it's not. Well, this credit report says it's still a joint account. You've got to do something about that to make sure that, because if the judge says that's your ex-spouse's and that ex-spouse continues to pay it late, it will definitely have an impact on your credit report.
Correct. And therefore your ability to get a mortgage or
car, credit card, any type of fairly priced credit is going to be exponentially more expensive if we don't try and minimize the damage of not executing a divorce decree properly. Right. Okay. So we'll see a lot of credit rebuilding that we have to be able to do. So if that's the case, secured credit card will help start building credit again. We'll also see.
Do you want to talk a little bit about what a secured credit card is? Versus
sometimes you just kind of assume that everyone knows that, right? Okay, so what happens in a secured credit card situation is that like Capital One has one, or other banks will have one. A borrower will write a check for $500 or $1,000 that Capital One will hold on retainer, but that becomes security for the credit card. So they'll start using that and they'll report to the credit bureau. So their repayment history will start reporting. Capital One's happy because they have security for the line of credit that they have.
Right, up to $1,000.
Yeah, and then this person who's rebuilding their credit will be happy because they're borrowing against it, they get a good payment history. So as they try to rebuild their lives, these are some of the tactics that they'll use. An easier one is if hopefully if there's a parent or a family member that's involved and we'll add them as an authorized user. I don't know if you want to call it cheating, but it is kind of gaming the system a little bit, but it does help
borrowing
to reestablish
the credit of someone that might have, you know, more established, like longer credit history, a better credit score, and that and sort of transfers to the individual.
It doesn't have as much of an impact as it used to, and the credit scoring models are kind of onto them. Sometimes it can be a detriment if they already have a lot of established credit, but it does still help usually. Okay, so we said pull the divorce after credit, after a divorce is, pull your credit after the divorce is finalized to make sure all of debts are your name, try and get to a 640. And if you have to rebuild, then get a secured credit card. So, okay, so now moving from credit to capacity. Establishing income to be able to qualify for a mortgage. Now you've talked about it before, about alimony, child support. Getting established back in the workforce,
and getting back up to the income level that one may have been before, or getting to an income level where they would qualify for a mortgage for the size home that they want or need. And that's, you know, that's kind of a longer term, you know, game there. You know, it's like it takes a little bit of time to get there, but it is possible, and it's possible to get there in a much more efficient or fast way if you plan for it, like starting, you know, if possible before the divorce. Now sometimes that's not possible because divorce is sprung on people and it's a surprise, so they're often trying to play catch up, but waiting until after the divorce is final to do some of these things it's going to take longer. But it is possible, and sometimes from an emotional perspective, people just need this part of their life to be finished so that they can move on and focus on the future and their career and really building up their income.
Okay. So I do know that child support often comes into play. Has to be paid. We said in the other one, but again, for just for everyone's benefit, make sure it's documented, because I know people that will pay in cash.
And there's no documentation for the payer, and there's no documentation of where this cash came from.
Now, can you just suggest if somebody has to pay by cash, can they go to the state of Missouri and have it be the third party that administers it?
So I'm not sure that they would take cash payments, but what one could do is perhaps if they have a bank account, they could go and get a cashier's check. They could go and get a money order, They could have some other form of documentation that they've been making this child support payment. Nobody wants to be in the position, I mean, from utilizing child support as an income, you know, to the person receiving it, it's important to have this documentation of where did this money come from and what is the purpose of this money. But also from the perspective of the person paying it, one does not want to find themselves in a position where they have to prove that they've been making these payments for the last, 5-10 years, and they don't have any documentation. It isn't, so you can't support it if you have no written documentation. So, in instances where somebody has the option to have it withheld as like a wage withholding, or make it via direct deposit or transfer, always go for one of those, because it provides a paper trail and support for both the person paying it and the person receiving it.
Got it. And then we talked about investments.
Correct.
So we want to be able to start taking a distribution, so we can document the distribution for people of retirement age.
Correct. And so even in situations where maybe, just maybe, there is a Roth IRA, or if there's just a brokerage account, a plain investment brokerage account, one can also access that with a Roth IRA, you can access up to the principal that you've placed into that account without penalty. With a regular brokerage account, you can take distributions from that because that was placed in there with after-tax dollars. So a couple of things to consider is if you're selling securities, you have to understand what it means from a tax perspective and really what that means for your overall financial objectives. But sometimes, just sometimes, it's the bridge or the support that somebody needs in order to take that next step in establishing a home for themselves or a financial, threshold.
And the last bit that we wind up seeing is if anybody's had a material layoff, a layoff for a material amount of time, just to be able to raise the children, forego their career. 6 months back on the job.
Yes.
6 months back on the job is the number that to which we can start using that income number to qualify for a mortgage.
So in the instance where somebody is either needing to get back up to a certain income level, maybe they have gone back to work but they're just not at the right income level, and say 6 months in, they're just not there at that income level, could they then also take a distribution from?
We've done something like this before. If they're of retirement age, we can start talking about using distributions. We just need to be able to support the distributions, because a lot of times what you see, people that are good with their money and have a lot to save don't necessarily need it.
Right.
But we have to show it.
Correct.
They might be of retirement age, but I'm not I'm at 62, but I'm not gonna take my Social Security until I'm 65.
Right.
Well, that might be all fine and well, but we need to show that you make another $1,500 a month, take your distributions, and then do what you will with them.
Right.
But we need that for the approvability of the
so they could invest that into another account.
hang on to it, sit on it,
Correct.
whatever they wanna do, push
Right.
it back if they so choose to. So yeah, we do see a lot.
But in order to figure out what is going to work, it takes a little bit of planning and discussion and working with, a knowledgeable advisor and working through all of that.
A lot of moving parts on some of this stuff, yeah.
Absolutely.
So, all right. So finally, the collateral. Now, what are we going to do with the marital residence or residences? Who got it? How's going to get out of my name or out of one spouse's name, and the mortgage out of one spouse's name, and directly and specifically into the name of the
So that and one thing that we haven't talked about yet, sometimes I see that spouses, I always recommend an appraisal, just because everything needs to be valued when making a determination of who's getting what and what the financial agreements are and what the overall value of the marital estate is. For various reasons, cost usually is the driver. Some spouses just choose to agree upon a number. So in instances where the house hasn't been refinanced into one person's name, or the house hasn't been sold yet, oftentimes the value is going to be different than what was expected. Either the market has changed, or they were a little more conservative on the estimate and those sort of things. So that can sometimes impact what the refinance looks like, just depending on how much equity is in the house. Because a lot of times what we see is either there's no cash out from the house to the spouse that is, going to purchase a new home, okay? Or there's a portion of the equity that is going to be distributed when the home's refinanced. So ultimately the person keeping the house is going to have a larger mortgage than before. But if there isn't enough credit or enough equity there, it could change the terms of the loan and the mortgage and complicate things.
So yeah, you can have owner's pride to think, okay, my house is worth $300, but the appraisal comes back at $270, and now you get another.
If the mortgage is $250,
in an already potentially contentious situation, you've got to start arguing over equity and a lot of that.
Or it's a lot, oftentimes it's, well, what do we do? Like, what do we do now? Where do we go? What does this mean for us? And even if at that point they decide to sell the home, there still isn't going to be as much equity as was expected before to start in new homes after the sale, commissions and costs that go along with that.
So yeah, because at a good rule of thumb, 6%. Not to mention what costs are going to go to being able to prepare your home to be able to sell. So,
correct.
Yeah.
There's a lot to consider there.
A lot to consider there. So yeah, pulling cash out to be able to compensate the departing spouse for their interest.
Correct.
There are special programs that will allow for it to not have special rules to be able to compensate the departing spouse without having to necessarily have the same pricing attachments of calling it cash out. So, and that's that gets to be the toughest one, because somebody's expecting that money.
Right.
When the person who's taking the home can't qualify for it yet. So again, it's that same thing. Get pre-approved before the divorce is finalized to make sure that the spouse, which is taking the home, has the capacity to be able to take the collateral completely. Otherwise, it could have the potential to put everyone's life on hold.
Absolutely, and it can cost both spouses financially, and cost them a lot more financially than what they were expecting when they made their agreements. And so it's always better to figure out okay, this is what our agreement is and this is what we plan to do, but is it actually feasible? Can we actually do this, and does it make sense?
You guys agreed to it, but can it actually, you guys can actually pull it off, right?
Correct.
Right. I think that pretty much covers up our 3-part series. Now, one thing I do want to know, I figured I'd ask you this like in the last one, but
sure.
Okay. Single most important tip. Somebody comes to you, what's the single biggest mistake that you see people make when they go to get divorced?
Doing no planning whatsoever. No planning.
So I just wait for me to be so pissed off at you that I'm just gonna go file. Is that what this is? Yeah.
Not necessarily that, but not taking the time to work through, yes, you have to gather the things that you need to gather, the financial information to gather to go, basically complete a divorce. But really understanding, what does this mean for us going forward? A lot of times, the process is you just have to gather the information. It's called the mandatory information for the divorce. It's just a screenshot in time as it is today. And in most situations, unless an individual or a couple is working with a financial person specialized in divorce, that's all they look at. And they make decisions upon that. What isn't considered is are these good decisions? Are these good, sound financial decisions, not just today, but in the future? Because it's you can look at everything as a mathematical equation, but that's just math. That doesn't tell you what this means for both of you going forward. That's the whole, this is the agreement, but what does this actually mean? Is this a good, sound financial decision? And that's what I see missing, is that evaluation of, this is well, fine and good as it is today as a married couple, but that's not what it's going to be going forward. What does our financial future look like going forward? And how do we structure this financial settlement in a way that allows both of us to support our children, support ourselves, and continue to build our financial future?
Failing to plan is planning to fail, right? Okay.